Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis and a warm welcome to Money Talk for this Wednesday, the 12th of June. This latest business, economic and finance news for the start of the new day in Asia is coming up, and this podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, the US Federal Reserve Open Market Committee has commenced its June meeting and will announce its decision on US interest rates in the early hours of Thursday morning, Hong Kong time. Policymakers will also be updating their summary of economic projections, known as the dot plot, to estimate where they see rates at the end of this year. Fed watchers expect the forecasts to show a reduction in the number of cuts policymakers see this year, but the Fed is unlikely to adjust rates at this meeting. Domestic tourists in China spent less during the Dragon Boat Festival holiday compared to 2019. Domestic tourist spending rose to 40.4 billion renminbi, which is about $5.6 billion during the three-day holiday that ended Monday. That's up 8.1% from the same festival a year ago, according to a statement Monday from the Tourist Ministry. Despite that increase, the average spending per traveller was 12.3% lower than 2019 levels. Premier Li Qiang will travel to Adelaide, Canberra and Perth in a 4-day tour, the Australian government said in a statement on Tuesday. He'll be the first senior Chinese leader to visit Australia since his predecessor Li Keqiang toured in March 2017. Beijing has been pushing for closer ties with Canberra, while Mr Albanese's government has only emphasised the need for stabilisation. And before arriving in Australia, Premier Li Qiang will visit New Zealand in the first trip to that nation in 7 years by a Chinese premier. Tesla CEO Elon Musk said Tuesday he would ban Apple devices from his companies if OpenAI's artificial intelligence software is integrated at the operating system level, calling the tie-up a security risk. The remarks follow a presentation Monday by Apple when the iPhone maker said that customers would have access to OpenAI's ChatGPT chat box through the Siri digital assistant. Apple said it's partnered with OpenAI to integrate ChatGPT into its devices. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Le Shah, Asia Chief Economist at BBVA. With a view from Japan is John Beirne, Principal Economist at the Asian Development Bank. And if you want to get in touch with any questions or comments, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, the S&P 500 and Nasdaq closed at fresh highs on Tuesday ahead of key inflation data later today and the Federal Reserve's outlook for interest rates due tomorrow morning. The S&P 500 gained 0.3% to 5,375. The Nasdaq Composite added 0.9% and popped to a fresh all-time high of 17,344. The Dow lost 121 points, or 1/3%, ending the day at 38,747. Apple shares hit a record high, pushing the company's valuation back above $3 trillion in the wake of its decision to partner with OpenAI to roll out its new artificial intelligence system. The stock was up 7.3% to its first record close of the year. US Treasury yields fell, extending declines after a 10-year note auction met with strong demand from investors. The 10-year yield settled at 4.4%, down 8 basis points from Monday, and the 2-year yield was 6 basis points lower at 4.83%. The US dollar index extended gains for a third session to 105.3 on Tuesday, the highest level in about a month, and the euro continued to outperform on political uncertainties. The single currency fell 0.2% to about 107.5 against the dollar. In Asia, the Japanese yen slipped 0.1% to almost 157 yen per dollar. The Chinese yuan was 0.1% weaker in onshore markets at about 7.25.5 renminbi to the dollar. That's ahead of inflation data this morning. Gold rose 0.1% to $2,314 an ounce. Brent crude oil was 0.4% higher at $81.92 per barrel, and Bitcoin is down 3.4% at $67,180. Hong Kong and Chinese equities led losses in Asian markets on Tuesday as the markets reopened following the Dragon Boat Festival long weekend. The Hang Seng Index shed 191 points or 1% to 18,176. The benchmark index was hit by a sell-off in shipping companies amid concerns over rising tariffs on China's exports. And the EU is expected to announce additional tariffs on Chinese EVs this week following a probe into the sector. COSCO Shipping, one of the world's largest container shipping companies, plunged almost 13%. Property developers were weak after the Hong Kong High Court ordered Dexin China Holdings to wind up 3 months after a petition was filed by China Construction Bank and a year and a half after it defaulted. Dexin shares dropped 6.6% on Tuesday before trading was suspended, and the Hang Seng Mainland Properties Index fell 1.1%. On the mainland, the Shanghai Composite Index dropped 0.8% to a 7-week low of 3,028. Investors cautious ahead of Chinese inflation data due this morning. And the Hang Seng projected to open about 140 points lower at around 18,030. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests as we build up to the Fed meeting, which is going on overnight. We have with us Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, our regular Wednesday commentator. Morning, Enzio.
Good morning, Peter.
And also with us is Lashar, Asia Chief Economist from BBVA. Morning, Shark.
Morning, Peter.
So as we heard there, the FOMC has commenced its June meeting and it's going to announce its decision on US interest rates in the early hours of Thursday morning, Hong Kong time. Policymakers are also going to be updating their summary of economic projections, which is known as the dot plot, to estimate where they see rates at the end of this year. Expectations that rates will remain higher for longer follow several months of stickier than expected inflation. The US Bureau of Labour Statistics will publish its consumer price index data for May later today, just hours before the Fed's rate announcement. And the CPI is expected to remain at 3.4%, while the core rate is forecast to decrease slightly to 3.5%, which is a fresh 3-year low. Enzio, what do you think, first of all, the Fed is considering about the US economy? Where do you think it stands?
First of all, I think that it looks very much at the consumer price expenditures indicator, which is still 40% above the 2% inflation target. It's the CPE, as it's known, is actually at 2.8% forecast at present. So there's still quite a way to go. And the other point is that services inflation in America remains rather sticky. Quite how Fed funds affects services inflation, I don't know. I can see it on the goods side. I can't really see it on the services side. So it's a bit of a sticky game. That's why I just think that it's going to remain pretty sticky for some time. Also, the Fed funds rates.
This inflation is hard to get down, isn't it?
Yes.
Because the sort of things that are going up now, like housing costs, rentals,
Yes.
Health insurance, you can't avoid them really, can you? So you've got to basically have them.
Yeah, I think it's just perhaps as all of us economists know, there's always a mismeasurement in all of these polls or whatever you conduct in any country of the world, and that comes with the territory. So I'm not chiding the statistics officials in America, but maybe it is time to try and update the way that people look at inflation to include more services and really to move away from this somewhat mechanistic, too much money chasing too few goods, monetarist postulate that really came out in about the 50s or 60s. It's maybe had its day.
Shark, it's interesting, isn't it? At the beginning of the year, there were quite a few economists predicting a recession this year, but that seems to have not been talked about anymore. That seems to have gone away. In fact, an FT poll now that occurred earlier this week showed a majority of economists not expecting a recession. The US economy is doing quite well, isn't it?
Yes, I think this resilience of the U.S. economy is better than many people expected, in fact, including me, okay? But if you look at the performance of the economy, I think I agree with Enzio's point. They are supported by very strong service sectors. Remember, during the pandemic, the U.S. consumer, they consume a lot of imported goods because at that time they were limited for their movement. But now, when they reopen the economy, they start to consume the service again. And this looks like a very good dynamic because I think the U.S., they almost restored their economic and social order in 2022. And this kind of the service sector has been expanding for almost 2.5 years. So that shows that economic resilience is very good in the United States. But at the same time, if you look at the income side, we know that in the past, during the pandemic period, the U.S. government distribute a lot of cash to the household, and the household, they accumulate this kind of, we call it excessive saving. But now, according to some indicators published by Fed, in fact, that's I think the St. Louis Fed, they are close to running out of this kind of excessive saving. So what's going to happen in the rest of the year will be interesting. Maybe I think on the good part, I think this momentum is quite good. They can continue to maintain a good performance, especially in this service sector. But at the same time, if people they run out of their savings, maybe the momentum will slow down. Okay.
And they're building up on their credit cards, aren't they? So you look at the credit card data.
That's true.
That's where the spending is coming from now. People maxing out on their credit cards.
Yeah, if you look at this credit card and the other loan data, you can notice that there's an uptrend of this delinquency rate recently. So that shows in the past, I think the U.S. consumers' balance sheet is very strong, we can see. But now they start to normalize. Even now, the delinquency rate is still lower than long-time average, but it shows there's some marginal change.
What could go wrong then for the U.S. economy? It's doing all right at the moment. It's chugging along. Doesn't look like it's heading for recession. It's slowing a little bit, isn't it? But still going at a decent pace. What are the risks going forward? What could derail that?
On my side, I think the first one, if everything looks okay, but if you keep this high interest rate, I think that you could cause some risks, okay? For example, if you look at this rental market, if you keep this high interest rate, no one want to build new houses because it's too expensive to apply for the mortgage. People said in the past...
You don't want to refinance at this rate.
2 years ago, you have a 3% this mortgage rate, but now you face a 7% mortgage rate. If this kind of high interest rate continued, they will build less, and you will see there's no liquidity in the market, and then you have to pay more for renting. You have to pay more to living in your house. I think that's one potential problem. So ideally, we will see some decent or some slower slowdown in U.S. economy, and then the Fed, they can lower their interest rate so that they can normalize the economy, normalize their policy rate.
But what is a normal rate? I mean, 5.25% to 5.5% right now. I know in sort of recent standards, and for what some people like to call the teenage scribblers in the markets, the youngsters who've never really seen a recession before, this seems high. But I remember there were long periods in the 70s and the 80s where interest rates were at this level and higher.
Much higher.
So what is normal now? How would you decide what is a normal interest rate that the Fed needs to get to?
I think the normal interest rate, if you look at this equilibrium one, usually this real interest rate, they will equal to your potential GDP growth. In US, that should be 2 to 2.5%, right? And then you have some comfortable inflation, so maybe another 2%, and put together you have a 4 to 4.5%. I think maybe nowadays, okay, this is looks no normal, but that means you at least you need to lower your country 5.5% interest rate a little bit, maybe not that much. I don't think we can go back to the to 10 years ago, because at that time we have this global financial crisis. You have to keep the interest rate at zero for a very long time. We cannot go back to the old time like that. But still, I think in my mind, I think that should be the normal interest rate should be lower than the current one.
So Enzio, really, whatever happens, I know there's a lot of debate about the Fed, whether it's going to cut in September or November, whether it does or it doesn't. The real issue is that when they finish cutting in this cycle, rates are going to be much higher than they were before. They're not going to go down to where they were, so we're going to have a higher sort of normal or neutral rate. Is that fair to say?
I think that's fair to say, because we've got weakening personal consumption already. In April, job openings are falling briskly, downward revision of the first quarter GDP, starting factory activity. So I think that there are plenty of signs just for a normal cyclical slowdown, which is exactly what you would expect with rising rates. The economic clock is ticking rather well. But I just wanted to briefly just highlight that the Fed funds are really, they don't have, in my mind at least, you're the bond trader, I'm not, but they seem to only have an effect on the short-term rates, particularly on the credit card debt and very short-term, because the Fed funds are only really the overnight borrowings between banks and other entities that to maintain the reserves at the Fed. So the effect on bond yields, which is, of course, where mortgages play in, that's, I think, very muted.
Well, the Fed's got tools, hasn't it, to keep the Fed funds rate in that target? Because the obvious question is, if the Fed says, okay, interest rates are going to be 5.25% to 5.5%, which is where they are now, how does the Fed make sure that that is where interest rates actually end up? But it has got a lot of tools in its armory that it can use to do that, including the repo markets, whereby the Fed, it can go and buy bonds off of commercial banks, treasury bonds, give them cash, which adds liquidity to the system. So it can do that if rates start to get tighter. And if rates get looser, they can do the opposite. They can actually give cash to the commercial banks and take bonds off of them. So that will affect the bond yields, the short-term bond yields anyway. And also keep the rates, the Fed funds rate within that within that range. So the New York Fed, which does all these operations, it's got loads of tools and instruments that it can make sure the Fed funds rate stays in that target. But the problem, of course, with bond yields is that they move according to lots of other things as well. That's so it's not just where the Fed funds rate is, as we saw overnight, on expectations about what the inflation data is going to say when that comes out today.
I think also the non-regulated, the shadow banking system, yes, it has something to do with U.S. interest rates, we know that, but there are just so many different ways of raising money these days, loan sharks and all that, and especially in the quest for regulation of banks, they squeezed a lot of the regulation out and pushed it into unregulated banks called shadow banks.
Yeah, well, there's lots of non-banks, aren't they, these days, who are lending to consumers.
To what happened before,
So in terms of what the Fed is going to do today or tomorrow morning, Hong Kong time, there's really no reason for them to change, is there?
No.
This would not be the right time to go and cut rates.
Yeah, if it ain't broke, don't fix it, in my mind.
Are they running into a problem, though, that if they do want to cut rates, the meeting after September is going to be November, right around the time of the election? If they were to do that, do they run the risk of people accusing them of being too political and cutting rates to help the Biden administration? So have they almost locked themselves out? If they don't do it in September, is that basically going to be it for the rest of the year?
I think they're always public officials like that are always in a no-win situation. They're always going to be accused of somebody, you should have cut, no, you didn't cut, why did you cut now? So of course the Republicans will be at their throat, so you're politicized Fed, but then who wants to politicize the Fed? In my mind, it's the Republicans. So it's kind of that's kind of a given in my head that they will always come under fire.
The other thing, Shark, that we got to look at is the dot plot, isn't it? This forecast of economic projections. Originally, at the beginning of the last dot plot, Fed officials were predicting 2 to 3 interest rate cuts this year. Presumably, they're going to have to revise that down.
Yes, I think that's a very important point to watch. I think because no one expects they are going to move this interest rate this time. So people will focus on how their projection will will change compared to previous one. I think there's a chance maybe they will reduce the times of the interest cut from previous 2 to 3 times to maybe 1 to 2 times. I think according to recent data out there, it's very likely they will revise their projections.
Common sense, absolutely.
So what could move markets on this? There's a lot of volatility being priced in around this Fed meeting. What is it that presumably some sort of shock maybe that they don't cut rates as much as people had thought, or cut more? So is that the thing that could move the markets?
Frankly, I think a lot of the information already priced in. So if you look at the recent discussion and other people's comments, I think now the market already priced in only one interest cut, right? I think maybe they could create some surprise if they maintain the previous projection. They said, okay, we still have a chance to achieve 2 to 3 times, and then the market will react, because now the market, I think that they price in less times of the interest cut.
That's unlikely, isn't it, based on what Fed officials have been saying over the last few weeks, where they've been quite hawkish really, and basically saying we need to wait, we need more data, we need more than just one piece of data.
In fact, I think that compared to their comments, maybe people they will focus more on the data outturn. Remember, today they are going to announce the CPI data as well. So
that's going to be maybe more market moving.
There's more market moving compared to this.
Good point.
And in particular, if it remains more sticky than what people have been expecting, that's going to be the key, isn't it, for the markets tomorrow. It's not, of course, the one that the Fed mainly focuses on, is it? It's the consumer price index rather than the PCE data that the Fed likes. But nevertheless, presumably there is a relationship between these two.
Well, I mean,
inflation rates.
You can't have one going up and the other going down. But I think the CPE, this Consumer Expenditures Index, that's still at 2.8%. That's still 40% above the Fed's target, as we know. But it's just important that listeners understand that that's actually what they're looking at.
Has at some point the Fed sort of got to admit that maybe getting to 2% is going to be pretty difficult, or will they just carry on emphasising this 2% number?
Well, everybody's blathering it. Probably even the Central Bank of Uganda is probably blathering that number. I don't know why the Japanese seem to be very keen on 2%. I don't know what's so magic about 2%.
The only thing is, I mean, what I would say about that is that there is, if you work out what happens to your sort of expenditure and your spending power if interest rates are at 2%, over 10 years it's reduced by about 22%.
Yes.
If the inflation rate is 3% over 10 years, your purchasing power is reduced by about 48%. I think that's the reason, must be, why it is important that, if you're going to change it to 3%, it sounds like, okay, not very much. We're just going from 2 to 3%. But over a period of time, this all compounds and starts to have a big effect on your purchasing power over time. So presumably they can't just sort of abandon this 2% target.
Well, that's actually what seems to be costing Biden. I'm not citing, but seems to be costing him on the management of the economy, because I was quite startled when I read in the FT that since he's been voted in, consumers have lost 1/5 of their purchasing power. That's 20%. That hits people.
And they know that. They just compare, don't they, to a point in time, which is around the time of the pandemic. Well, look, I'm paying 25% more for food now compared to 2019 when the pandemic
the wages aren't going up,
started. So this is a key element why Biden maybe is not getting the credit for the economy that he wants.
I think maybe another reason is that they fixed this 2% target quite a long time ago, right? Before the financial crisis. And then now I think they are very reluctant to abandon that one, because they don't want people have an anchorless inflation expectations. Right, so you emphasize 2%, and then suddenly you say, okay, 3% acceptable. We will have a 3%. Then I think many people now, if you look at the long-term inflation expectation, they're still very stable. Okay, but if you said 3%, I'm afraid they will change.
They might go to 4%.
They will have a 4%.
That would be market moving.
So at this moment, I think that they don't want to change that one because bigger trouble. So they said, but everyone knows at least I think in the next 12 months, it's very difficult to see 2%,
Yes.
right?
Yeah.
That's very hard.
Now, we mustn't forget there is another central bank meeting this week. The Bank of Japan meets on Friday. Now, they're expected also to leave interest rates unchanged, which are in a range of 0% to 0.1%, rather different from where the Fed is. It was a unanimous decision at the last meeting in April to keep policy settings where they are. Now, the Bank of Japan, I think it's fair to say, they would like to tighten policy, wouldn't they? They would like to raise interest rates partly to stop the depreciation of the yen. But the data's just not helping them, is it, really?
Yeah.
Well, the data isn't helping, but the policy moves are, because the bank wants to, as you were saying before, Peter, they want to sell more bonds, and that means that they give bonds, and thus they get money, they take money out of the system. So I think you will find a worsening of the economic time in Japan because of that policy move, which is going to get lost on most consumers, but I think that's really where the action is. It's not as much the interest rate, it's the money supply swirling around in the system. So I'm not forecasting any dire outcomes. I'm just saying that will have an effect on this, what we call the excess supply of money, using the economic clock to diminish it.
I presume the Bank of Japan really has no choice but to move really slowly and cautiously, because we've had interest rates ultra loose now for so long, this extraordinary monetary policy that really no one has ever tried before. To try and get out of this is going to be quite difficult, isn't it?
Yes, I think they already form kind of another equilibrium, right? The low interest rate, low inflation, low growth. That's quite characterized Japan over the past maybe 20 or even 30 years. Now they want to change. I think it's a good time to do that one, because you already have the inflation, and although maybe the GDP figures in the first quarter was not that satisfactory, but anyway, you have some good stories. Buffett invests a lot in Japan's market, and I do see some Japanese firms, they have a better performance than before. I think that's a good dynamic. But I agree with you. For the central bank policymakers, they must move very cautiously to avoid any unexpected shocks to the financial system. As Enzio said, the whole system already be there for quite a long time, and they need to continue to issue bonds. If you look at they have maybe 300% of the GDP, right? So that's a very high debt level. So they must be very, very careful. Otherwise, that will cause serious trouble in financial system.
Besides which, if they increase rates to try and get the yen up, in other words, to reduce imported inflation, then of course that would hurt the Japanese consumer.
The economy, wouldn't it?
Yeah, and that's
overall.
75% of any economic growth in a developed economy. So I think it's sort of easy does it really with them continued of that, yeah.
But this is part of the bind they're in, isn't there? Because this imported inflation is reducing the impact of all those wage hikes that we saw. So ultimately, the Japanese household wage growth is still negative when you take into account, the price hikes that are going on.
Not only that, it also flattens this argument that a cheap exchange rate helps exports. When I wrote my book on trade myths, I kind of knocked that argument out of the ballpark by just saying that, first of all, if that were the case when the yen was so strong, how come the Japanese or the Germans had trade surpluses with a strong exchange rate, and the Americans have had a trade deficit with a weak exchange rate? So it's a bit simplistic, and one reason for that is because when you have a weak exchange rate, like the yen currently at about 157 or whatever, then of course you have, as we were saying, we were agreeing, higher import costs, so the factories have to pay more for the imports. So it's a two-edged sword, really, this one. It's not a panacea.
At the end of the day, though, really, does it matter what the Bank of Japan does? I don't want to be mean to them, but what's really important is what the Fed does, isn't it? That's really going to dictate, this difference in yields between Japan and the US.
On the exchange rate side,
it's
but
the
not
US
on the
that
stock
matters.
market side. I think that's where if the Bank of Japan creates an excess demand for money, then there's no money for the stock market. So I think from a domestic side, I think that there is some importance, but no, the leader is the Fed, quite clearly.
Yes.
Yeah.
And I presume the Bank of Japan could surprise. There's more leeway, isn't there, for the Bank of Japan to surprise at this meeting than maybe the Fed, as we were talking about a bit earlier. They could suddenly raise interest rates, I suppose. They could announce a reduction in bond purchases as well. There are some areas there where there could be a surprise for the markets.
Yeah, I think that compared to the Fed, I think they have a more uncertainty around this BOJ's policy decisions. Regarding to this exchange rate issue, I like to add that initially people expect that this exchange rate depreciation will benefit Japan a lot. I think it holds true for some time, because when you have a very weak currency, then you have more tourists visiting, and you can export more. That's good. But increasingly, I think this weak Japanese yuan start to erode the Japanese consumers' confidence. So if you look at domestic consumption in Japan, now they start to slow down. I think for the BOJ, they must engineer a balance between this currency depreciation and domestic monetary policy decisions. I think it's a very challenging task for
useful to remember also
there.
that the bond yields in Japan, 1% on the 10-year Japanese bond and 4.5 on the US. So that's a big, huge gap.
Although it's notable that the JGB yield has moved above 1% now over the last sort of month or so. So there is a move upwards, but still a massive difference, as you say, compared to the US. Let me ask you about China, because we've had some data from there as well. First of all, dragon boat spending. Domestic tourists in China spent less during the Dragon Boat Festival holiday compared to 2019. Domestic tourist spending rose by about 40 billion renminbi, $5.6 billion during the holiday that ended Monday. Now, that is up 8.1% from the same festival a year ago, and domestically, traffic rose 6.3% from last year, 110 million trips, the ministry reported. But despite those increases, the average spending per traveller was 12.3% below 2019 levels. So this is really the story of the Chinese consumer, isn't it, Shark? Cautious spending.
Yes, exactly. I think that's not a good sign, because if you look at the previous holiday seasons this year, the Chinese consumer spending always exceed their 2019 level, but now they start to slow down. And if you look at the Chinese growth on domestic consumption, I think they're quite driven by this tourism, by this kind of the service-related factors. But unfortunately, now we see the slowdown of this momentum in this service sector. I think in April, we see this retail sales only grows by 2.3%. So I'm afraid this low growth will continue in this consumption sectors in China. So that means now the exports still hold well. So that means that the economy, they are not in a balance structure. So they need to rebalance the economy. The consumption has been too weak, although this investment is okay, export very good compared to the past performance. Now the main driver of the Chinese growth mainly focus on this export. I don't think it's
if you look at the data,
one.
Chinese exports grew 7.6% in May. That's the fastest in 4 months. But imports just 1.8% growth. I mean, that's not a good sign, is it?
That's related to domestic demand. So that's now good news.
But I presume it's going to be difficult, isn't it, for China to just rely on exports to drive its economy, particularly with the geopolitical environment at the moment. The US, Europe in particular, are just not going to stand for these exports coming into their markets.
That's one point. The other one is just from an arithmetic perspective. It's always the trade balance, because I mean it's great if you have strong exports growth, but then if you also have strong imports growth, growth, well then, and the trade balance as a percentage of GDP is generally very, very tiny. So it's that net effect that I think it always makes me very leery of its export-led growth.
But that trade surplus is $83 billion for the month of April compared with $65.6 billion a year earlier. So the surplus is still rising, which is going to upset some of these trade partners.
Absolutely, yeah. Well, also obviously going into the election years, as my friends in the Senate Foreign Relations Committee told me years ago, and it still remains true to this day, in America, China is for free. Nobody knows where it is. They don't speak English. They're all commies anyway. So who cares? It's just it's a very McCarthy-esque, simplistic view of life.
What was interesting, Shark, in the data was when you look at regions by export destination, first of all, just how important the ASEAN region has become. Exports grew 17.4% year on year in Asia, and so that brings the year-to-date growth to over 4%. And also there is strong exports to Latin America, growth this year, so far this year, 8.6%. This is significant, isn't it? It looks like China's finding new markets to try and avoid these tariffs, or new ways of getting into the United States and Europe, because there's going to be re-exports from these countries.
I think both. Yeah, I think both. Of course, they used other countries in Latin America, or we call the global south, to circumvent some of these tariff imposed by US or even Europe on their Chinese exports. But at the same time, I think now, because we have some Latin American clients, now China is intentionally to strengthening their relationship with this global south, even Middle East. So all these global south, because they know that they can not only focus on these advanced countries at their export market, even these exporters in China, they have this kind of awareness. They start to, I can make less, I can face a high risk of this credit, but we are willing to explore this global south market than before. So I think that's a trend that will continue.
And by category, auto exports, big source of strength, up 20%. 20.1%, in fact, year on year in the first 5 months of the year. That's going to be a problem as well, isn't it?
Yes, I think, of course, I mean, for the export to this global south is okay. You know, in Chile, in Mexico, all these Chinese EV cars, they are very popular there. But for EU, for United States, I think that will cause more trade frictions with China. Yeah. Another one, I think, in terms of the export, if you look at semiconductor, for this relatively low levels semiconductors, maybe above the 14 nm, I think the China export a lot. They have the growth rate like 20% was. They're exporting at semiconductors. So.
Okay, well, thank you very much. Good to hear your thoughts there. You heard Lashar, who is Asia Chief Economist from BBVA, and Enzio von Pfeil, who's Capital Preservation Specialist at Financial Shield.
Peter Lewis's Money Talk.
I'm joined now by John Beirne, who is Principal Economist at the Asian Development Bank. Very good morning to you, John.
Good morning, Peter. How are you?
I'm very well, thank you. Two important central bank meetings this week. The US Federal Reserve meeting right now. It's going to give its decision early hours of tomorrow morning, Hong Kong time, and then the Bank of Japan coming up on Friday. Let's start with the Fed. Is the Fed satisfied about where inflation and the economy is at the moment, do you think?
Well, I think, the outlook for inflation will be an important and key consideration in any decision on interest rates. We have seen strength in the labor market, which was above expectations, which really points us in the direction of a higher for longer interest rate scenario. At the start of this year, we had been looking at several rate cuts expected, 6 or 7 rate cuts this year. And, recent developments have reduced that significantly. From anywhere between 1 and 3 expected.
How is it that the markets have got this so wrong? Because, as you say, 5 to 6 rate cuts being expected at the beginning of the year. Several economists calling for the US to fall into recession. No sign of a recession, really, is there? Now markets are pricing in just 1 rate cut by the end of the year, and that could well change after this Fed meeting.
Yeah, that's correct. I mean, the real question is whether we are still in restrictive mode in terms of monetary policy, the economy in the US has been very robust to the high levels of interest rates that we've seen. We can see this playing out in growth. We can see this playing out in the labor market. So, where neutral rates lie is something to be considered in this context. And, we're unlikely to return to the levels of interest rates that we had seen prior to the pandemic, implying that rates of growth that we see at the moment are in line with higher levels of interest rates than we had seen in the past. So neutral rates are higher and the labor market is able to perform very robustly, even in a scenario of high interest rates.
So you could argue that with rates at 5.25% to 5.5%, they're okay. The economy is surviving pretty well with interest rates at that level.
Well, at the moment, it appears to be the case. On inflation, of course, there is some movement downwards, but it's not to the extent that it would trigger a change in interest rates because of the strong growth that we're seeing in the economy overall. So I think it puts the Federal Reserve in a difficult position in terms of its monetary policy going forward. As I said, expectations on cuts have been reduced significantly in number. There would be no surprise if we don't see any interest rate cuts this year. It really depends on how the data plays out.
And of course, we've got to look at the economic projections, haven't we, known as the dot plot. So it'd be interesting to see what the members are saying on the FOMC. But clearly, they've got to revise them down, haven't they? Because I think at the moment they're forecasting between 2 to 3 interest rate cuts this year. They've got to certainly admit that that's not going to happen.
Yes, the projections for the rest of the year will obviously be an important factor. And we will expect some revisions, as you rightly point out, in that regard.
And what does it mean for central banks in Asia? We'll get on to Japan specifically in a moment, but other central banks in Asia, with the Fed staying on hold, does it also restrict their ability to move?
Exactly. The higher for longer interest rate scenario really spills over to other emerging markets and other developing economies at the global level. It's likely to mean that there is going to be significant additional pressure on exchange rates, for example, and that it could, in fact, trigger some inflationary pressure as well. For economies that are, holding high proportions of US dollar denominated debt, this can also have implications for these economies in a higher for longer scenario whereby, the strength of the dollar would increase the local currency value of that debt. And in some cases, it could push it to an unsustainable level. So there are significant implications, I think, of what will happen at the Federal Reserve in terms of spillovers to emerging markets.
And is there any risks on the horizon that could suddenly change the outlook for the US economy or change what the Fed needs to do? Is there what could go wrong here?
Well, what could go... Do you mean in terms of what could trigger an even worse scenario where we would see not only higher for longer, but even increased rates?
Yep, presumably that's one of the risks, isn't there, that we could somehow see higher rates. But also maybe is there anything that could change on the downside that could suddenly change the view on the US economy for the worse?
Well, I think that if we see inflation coming down more than expected in the US, this could be something that could trigger a change in the expected path of US monetary policy. And that would, of course, have implications for the US dollar, which would alleviate some of the risks that we mentioned before for emerging markets.
And on the upside, presumably we've got this data coming out later today, the CPI. If inflation looks more stickier than it is, or even shows signs of moving back up again, presumably that will put pressure on the Fed to raise rates.
Well, a lot really hinges on what we will see coming out in the inflation data. But as I said at the start of our discussion, it's really a question of whether US monetary policy is in restrictive mode, given what we're seeing playing out in the real economy. So despite these high levels of interest rates, despite some trickling down in inflation, which remains sticky, we're still seeing a very robust economy in general and a very robust labour market in particular. So it really makes the job of the Federal Reserve very difficult if it's deciding to reduce rates in that environment, of course.
And it's also making the job of the Bank of Japan difficult as well, isn't it? Because that interest rate differential between JGB yields and US Treasury yields is still high, even though the 10-year JGB is back above 1% now. There's still a wide differential there.
Exactly. As you said, Japanese long rates are above 1% now, but there still remains this significant yield spread between the US and Japanese rates, which is piling pressure on the yen, which is currently at around the 157 level. So this is a consideration for the Bank of Japan. Of course, it will be looking at what happens with inflation, what it regards as being a path towards a sustainable level of inflation over the medium term. And also, I would say, what is driving that inflation? And at the moment, we're still seeing evidence that it is really largely about supply-side factors, again, making it more difficult for us to expect rises in rates in the short term.
The Bank of Japan's in a difficult position, really, isn't it? It's got interest rates at 0 to 0.1%. It wants to raise them. It wants to try and stem this depreciation of the yen, but the data just doesn't seem to be helping the Bank of Japan at the moment.
That's right. I think, domestic demand is a problem, and this is related to what we're seeing as regards wages, as regards real wages, which continue to be problematic for the economy. So, inflation continues to outstrip wage growth. We are hopeful that there would be some change in this scenario during this year, but of course it remains very uncertain. The negotiations on wages by large firms, of course, are very positive, but whether that would spill over to SMEs is a matter of great uncertainty. And that could be something that could trigger a rise in domestic demand and enable demand-driven inflation, and thereby permit some rise in interest rates over the next few months. But at the moment, the data is not showing that.
And there's no, as you say, there's no sign really of these wage rises leading to this demand inflation that the BOJ wants to see so far, anyway.
So far, I mean, there has been some uptick in household spending on a year-on-year basis, but it's very uncertain whether this would be something that would be sustainable. The government has introduced some tax measures that can help to support disposable income levels. But really, I mean, the key thing would be whether nominal wage growth can be sufficient to outstrip inflation, not only across the large firms, but across the economy more broadly, particularly SMEs.
Is there more room maybe to see a surprise with the Bank of Japan compared to maybe the Fed? Have they got more room maybe to surprise us? They have done in the past, haven't they? And actually go and raise rates or do something on their bond purchases?
Yes, well, on the bond purchases, I think there is scope to do something there. I think market expectations are for some scaling back in bond purchases going forward. And this would, of course, help the yen, and this would be a form of tightening. But I think, really what's on the horizon is whether we will see demand-driven inflation in order to really address the yield spread, which we continue to see between the US and Japan. But, movement on bond buying is something that we could possibly see going forward. As you know, the Bank of Japan is holding a large portion of government bonds, and rises in interest rates in this scenario can also have some fiscal risks as well. So it's a really big challenge for the Bank of Japan in the current environment.
And when you look at the data, the GDP data, Japan's economy is still quite weak, really, isn't it? Although maybe not as weak as originally thought when the first GDP figure showed a 2% contraction, but still shrank 1.8%.
Yes. Okay. So in quarter one, the economy contracted by 1.8%, which was originally thought to be 2%, as you said. But I think this was largely driven by a one-off factor related to problems at various automobile companies who had to halt production due to, problems with complying with various safety regulations and so on. So I don't think that's really a reflection of what we would see for the remainder of the year, for example. Assuming that there would not be further production halts running into Q2 and Q3 and Q4. But I think largely it could be regarded as a one-off sort of negative shock on growth.
And what about private consumption? How's that looking?
Climate consumption. So, one of the things about Japan is that it's a net importer of energy. And, this has really been one of the factors which has contributed to what we've seen playing out in the last couple of years. So I'm talking about supply side inflation and yen depreciation. Now, one of the ways to address that, of course, would be to reduce reliance on fossil fuel, reduce reliance on types of energy that would be contributing to negative impacts on the environment more broadly. So I think that's one aspect. There is a focus on investing in renewable energy, for example, which would help to contribute towards climate goals. And also electric vehicles are coming into play more significantly, and there's a push by the governments to progress further on climate goals in those regards.
So at the end of the day, I think in conclusion, the Bank of Japan really has no choice but to move very cautiously, doesn't it? Because it's had this sort of ultra-loose monetary policy experiment for such a long time that it's got to be really careful in terms of how it exits that.
Exactly. If we look at the numbers of inflation, they are coming down, but the problem is growth is so fragile at the moment. So it does not lend itself really to the large hike in rates. So it's really a difficult position at the moment. Of course, it would be preferred to see some narrowing in this US Japanese interest rate spread, but this will be driven by not only the Japanese side, because it's a two-leg spread, of course, it would also be driven by what happens in the US. So if we would see some movement in terms of Fed policy easing, this would also help on the Japanese side as well, because it would narrow that spread.
Okay, John, well, thank you very much indeed. Good to talk to you.
Thank you, Peter.
That's John Beirne, who's Principal Economist at the Asian Development Bank.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter, which has a lot more business and finance news to go with this show. I'll be back tomorrow when, as we've discussed, it'll be Fed Day. Discussing the latest Fed interest rate decision will be Andrew Ferris, the CEO of Econosis Advisory, and William Ma, who's Chief Investment Officer at Grow Investment Group. With a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting, and then providing our regular weekly update from the UK on the British general election. It's Richard Harris, Chief Executive Officer at Port Shelter Investments Management. Please catch me tomorrow.
Money Talk.